We're going to talk a little bit about the energy and gas, because there's a lot of question, a lot of concern. Some of what we were reporting this morning was that the deal is not necessarily off, but it's on hold. That is the deal between the U.S. and Iran.
And obviously, when we saw the war begin, we saw those gas prices go up a lot. So we want to talk to energy fellow Ed Hers. He's a lecturer over at the University of Houston. Professor Hers, good afternoon.
Good afternoon.
Thanks so much for taking the time to talk to us. I think this is kind of such an interesting topic because you not only talk about gas, but energy in general. But I think the big one that a lot of folks, unfortunately, are talking about are those gas prices. After the war began in Iran, we saw those gas prices just skyrocket. Walk us through kind of what we're seeing now, what you expect to see happen, and when we might start to see those gas prices go down. I know we have started to see them come down now below $4 a gallon for the first time in a while, but what are we seeing?
Well, that's down just a little bit. And I think we're going to see higher fuel prices, gasoline and diesel, out through the end of the year at the very least. We know that there's not a deal yet. I mean, the president has said there's no deal. So let's just look at the economics and not the deal, because that's a political and military situation that is really beyond what we can assess. So starting in January, the price of oil, WTI, West Texas Intermediate, was $56 a barrel. That's after we had removed Maduro from running Venezuela. And just as an aside, in the U.S., we look at the WTI price. We don't care about the Brent price. The Brent market is a trader's market. It's not an exporting market anymore. Production's dropped 4 million barrels a day in the last 15 years. They have to import oil. So actually what they're doing is they're buying from the U.S. The U.S. Produces about 14 million barrels a day. We consume between 18 and 20 million barrels a day. Last year, we imported 6.2 million barrels a day to match up with our refinery requirements for heavier crudes. More than 4 million barrels a day of that comes from Canada. Of the oil that we imported from behind the blockade, for example, Kuwait, Saudi Arabia, so forth, it was about 490,000 barrels a day. So the U.S. is really in a pretty good situation in terms of being able to maintain a fuel supply. The issue, of course, is just the price. So as soon as the war started, we saw tankers chartered to take fuel from the Gulf Coast to Asian markets. Many of the Asian economies are not self-sufficient with gasoline and diesel. So right now, the producer or the consumer in Houston and the consumer in Los Angeles is bidding for these gallons of gasoline against consumers in Tokyo. And again, consumers in Europe as well. The blockade of the Strait has taken about 10 million barrels a day off of the market. Ordinarily, that would have driven the price up to about $196, $200 a barrel, $56 low. And the way the government has blunted that has released 172 million barrels from the Strategic Petroleum Reserve. The International Energy Agency has released another 274 million barrels. China has stopped importing 3 million barrels a day, so they've cut their imports dramatically. So the actual net impact of loss of production to the global market is really just 2 to 3 million barrels a day, and that's why the price hasn't gone up much above $100 at its worst, and also why it's not going down much below $70 a barrel right now.
Can we talk a little bit about that petroleum reserve that you mentioned? President Trump said this week that America was 4 weeks away from running out of oil from the reserve. So lowest levels now since 1983 when it was filled up for the first time. What is the concern there? How long will it take to replenish? Do we need to worry about replenishing it, and so on?
Well, we need to keep that reserve in place because we are dependent upon oil to drive our economy forward. This is literally what greases the wheels of U.S. commerce. Releasing this reserve was, in my opinion, very poorly considered. 172 million barrels from the SPR, almost 100% of that went overseas right away. Exactly as the releases from the SPR in 2022 that were undertaken by the Biden administration. At that point, the Republicans were complaining that President Biden was buying votes in the midterm election. Well, now here we are again, 4 years later, and goodness, the shoe's on the other foot. That oil went overseas. There's no doubt about it. So we're at a point where we've run down our inventories, not only our strategic reserve, but our commercial inventories. Oil traders are not religious. If they can get an extra 5 cents a barrel, they're going to ship that cargo.
Wow.
So I guess our big question is obviously you don't have a crystal ball, but you mentioned this deal's not quite signed, sealed, delivered just yet. So should we as American consumers of oil be concerned that this is not kind of done yet and that we are, as the president said, weeks away from running out of these reserves?
No, that's absolutely true. We should be worried about this. The CEO of Chevron, Mike Wirth, the CEO of ExxonMobil, Darren Woods, they've been on the road telling us we're running out of the physical inventory. In Northern Europe, they hit the bottom of the barrel, if you will, with diesel, and the price went to $150 a barrel last month in a couple of locations, and also for jet fuel, it hit $200 a barrel.
Wow.
And once these releases stop, then we're going to see the price begin to go up quite a lot. And if China goes back to importing 3 million barrels a day, which they can do, they have a lot of leverage across this market. They can do that. I mean, they have the money. It's one of the wealthiest economies on the globe. They can buy this. That would drive the price right on up, $150 a barrel, $200 a barrel, easy, if we don't get the Strait of Hormuz open. And even then, if we open the strait today, the U.S. Navy has said it would take 3 months to sweep the strait, to remove the mines. Iran certainly doesn't know where all the mines are. The Navy was blowing up the mine layers as fast as they could go out. We need to make sure that Kuwait, Saudi Arabia, Iraq, Bahrain, the Emirates, Qatar can put their oil wells back online. Qatar's got to restart their LNG export facility, and because it's been offline, that's driven up the price of electricity in the Northeast United States because they rely upon LNG to top up their market. And it's driven up the price of diesel disproportionately to the price of gasoline.
Very complicated issue, and one that pretty much everyone is keeping their eyes on because it does affect everyone. Thank you so much for your knowledge and your time. We appreciate it.
Thank you.